Does inheritance tax apply to non-residents? Have you ever wondered how inheritance tax works for those living outside the country? This topic can be quite confusing, especially when it comes to estate planning and inheritance laws. Let's break it down together. In the United States, there is no federal inheritance tax. However, there is a federal estate tax that can impact non-residents who own assets in the U.S. If you are a non-U.S. resident, you will only be subject to estate tax on assets located in the United States. This includes real estate and certain stocks in U.S. companies. It is important to note that personal bank accounts and life insurance proceeds are generally not included in this tax. Non-resident non-citizens have a very limited estate tax exemption of $60,000 for U.S. assets. In contrast, U.S. citizens and residents enjoy a much higher exemption of over $12 million. If your assets exceed this exemption, estate tax rates can range from 18% to 40%. This means that even modest holdings in U.S. real estate can lead to a significant tax liability for non-residents. Therefore, careful estate planning is essential for non-residents with U.S. assets. Strategies such as establishing trusts or gifting assets can help minimize tax exposure. Now, let's talk about inheritance tax. This tax is typically imposed at the state level in the United States. It is charged on beneficiaries receiving assets from someone who has passed away. Only a few states impose inheritance tax, and whether it applies depends on the state where the deceased lived or owned property, as well as the relationship between the beneficiary and the deceased. For non-residents, if the deceased was not a resident of a state that has inheritance tax, generally, no state inheritance tax will apply. For example, New Jersey does not impose estate tax on non-residents, but inheritance tax rules may still apply based on the beneficiary's relationship to the deceased and the type of property inherited. If you are a non-resident with property or investments in a foreign jurisdiction, it is wise to assess the local estate and inheritance tax laws that apply to those assets. In the United States, non-residents should consider estate planning tools like trusts, gifting assets during their lifetime, or purchasing life insurance to cover potential estate tax liabilities. Understanding the difference between domicile and residency is also important, as it affects the applicable exemptions and tax rates. Beneficiaries should be aware of state inheritance tax laws, especially if they inherit property from someone who lived in or owned property in a state with inheritance tax. In summary, inheritance tax can apply to non-residents under certain conditions, primarily depending on where the assets are located and the laws governing that jurisdiction. In the United States, non-resident non-citizens are subject to estate tax on U.S.-located assets with a limited exemption, making thoughtful estate planning crucial. State inheritance taxes may also come into play based on the deceased residents and the beneficiary's relationship to them.